For more information, please visit SGMAC Associates website.
In this presentation, I'm going to discuss refinancing a mortgage. So here is the problem statement. A homeowner is allowed by the bank to refinance an existing loan when the interest rate drops. The bank allows the homeowner to close the existing loan, add a service charge to the remaining balance, and rewrite the new loan at a new lower interest rate. Refinancing makes sense if it is lowers the annuity payment. Let's walk you through an example. It will help you to repay your house mortgage or car payment. Typically, is more used for a long-term loan for a home mortgage. The initial cost of a house is $500,000, and with a 20% down payment, the homeowner borrows $400,000 from the bank. The loan is borrowed at 4% APR and is to be repaid in 360 equal monthly payments. So that's a traditional 30-year loan, and payment is made every month. Now the homeowner has already paid 60 payments. So started the loan, paid it for 5 years at 4% APR. Now interest rate has now dropped to 3.5%. The bank will allow the homeowner to refinance the loan. The bank charges 1% of the remaining balance as service fee. There are other variations of this service fee, but we are using our representative service fee, 1% of the remaining balance. Bank will charge that service fee and rewrite the new loan. Should the homeowner refinance the loan? That's the question. First, we need to calculate the current monthly payment. Under the current plan, the monthly payment is $400,000 multiplied by the capital recovery factor, A over P, which converts the present value P to an annuity A. Present value is the price of the house, amount borrowed, 400,000. Interest rate is 4% APR or 4 over 12% per month, and you are planning to make 360 monthly payments for a 30-year loan. So that factor, capital recovery factor, and it comes out to be 0.00477. The equation is given there. You can any standard book on engineering economic analysis will give you that factor. So the capital recovery factor is 0.00477. So monthly payment, what you're paying now, is $1,908 per month. The homeowner has already paid 60 payments. So you already paid part of the loan. So the question is, what's the remaining balance after making 60 payments? A remaining balance represented by RB equals this expression, 400,000 times F over P, 4 over 12%, 60, minus 1908 times the factor F over A, 4 over 12%, 60. The first term represents the future value of the loan after 5 years if nothing was paid to repay the loan. And the second term represents the future value of all the payments, 60 payments the borrower has made so far. So once you evaluate that expression, we get the remaining balance of the loan at the end of 5 years. And that comes out to be $361,899.60. So you can see that even after paying for 5 years, the homeowner has only repaid about $39,000 or about $38,000 towards the principal, and remaining amount has all gone towards paying the interest. Now bank add 1% as service charge, so new loan amount is 1.01 times RB. The new interest rate is 3.5% APR. So there has been a 0.5% drop in the interest rate. You're interested to find out whether it lowers your monthly payment or not. Homeowner does not want to extend the life of the loan beyond 30 years. So the new loan has to be repaid in 25 years because you've already paid 5 years of the original loan. And that comes out to be 300 equal monthly installment. So the new capital recovery factor will be A over P, 3.5 over 12% and 300 payments. And that factor is 0.005. So your new annuity payment is the capital recovery factor multiplied by the remaining balance, which comes out to be $1,827.60. There's a reduction in monthly payment from $1,908 to $827.60. So we find a net reduction of about $80.40 due to refinancing. So if you refinance, even after paying 1% service charge, your monthly payment is going down by $80.40. So the question is, should you refinance? Um, if there's a reduction in monthly payment, it's a case for refinancing. Now the question comes, how much is the reduction? A $5–10 reduction may not motivate you to go for refinancing. So that depends on the individual borrower. But $80, I would I'll refinance if it is lowering the monthly payment by $80. The parametric form for this example is as follows. Um, your original annuity payment is initial cost times the capital recovery factor with original interest rate and original length of the loan. Remaining balance, we have talked about this expression. IC times F over PI, comma M minus AP times F over AI, comma M. M is the period that you have already paid for. In our example, M was 60 payments that you have already paid for. Your new loan amount is 1 plus the service rate in percentage times RB. Your new annuity payment is new loan amount times A over P factor, A over P I prime and minus M. That's your new capital recovery factor with a new interest rate and reduced length of plan period. Reduction in payment is AP minus AP prime. Refinance if the reduction in payment is positive. So, one can use a simple, one can develop a calculator based on the calculator.
For more information, please
The
visit
variation
SG
that
Mac
I mentioned
Associates
before
website.
most often expressed
For
as
more
a
information,
percentage
please visit
of the
SG Mac
remaining
Associates
balance.
website.
It will be a flat fee.
For more
Loan
information,
could
please
be
visit SG
written
Mac
for
Associates website.
a new longer time period that will change the interpretation. But on a typical refinancing, you don't extend the loan period. So this gives you a new loan amount at a lower rate, and the general recommendation is it's a case for refinancing if this difference is positive. And here are the terms I have used. I see the initial amount borrowed, RB remaining balance, N is the length of the original payment plan, 360, monthly payments for a 30-year home mortgage, S is the service charge, you just talked about it, and AP prime is the new annuity payment after refinancing at a lower rate. I is the original borrowing rate, and I prime is the new lower rate available for refinancing. It is assumed that the borrower does not want to extend the pay period beyond n time units. So that's a typical example of refinancing. How will you go about it when there is a drop in the borrowing rate and bank allows you to refinance with a service charge.